want an exposure to a market or an
Everything they need in one place.
The world's foremost authority on individuals, advisors and institutions.
Hello and welcome to the Morningstar series, Why Should I Invest With You? I'm Emma Wall and here with me today is Paul Niven, manager at the Foreign and Colonial Investment Trust. Hello Paul.
Hello Emma.
So you've recently taken over the Foreign Colonial Investment Trust, and one of the decisions that you're making is to reduce domestic exposure. Why is that?
Well, a decision was made to make the trust more global in nature, and around 18 months ago the trust had 35% in UK equities. We've progressively reduced that down to around 20% at the beginning of 2014, and during the first quarter we actually cut that further to around 10% exposure. It really relates to the opportunity set. The UK market, as you know, is relatively concentrated in nature, and it's our view that it's an investor's benefit to take a much more global approach in terms of how they approach accessing opportunities.
I mean, it's one of the things that UK investors are often guilty of is having a domestic bias. But as well as that sort of emotional play, the UK has done very well over the last couple of years. Equally so have other developed markets like the US and Europe. Will you be trimming there as well, or is it much more about more globally balanced?
Well, we're certainly more globally balanced, notwithstanding the fact that actually our US exposure has offset naturally as we become more global, and that's where clearly many of the largest companies reside. We have increased exposure more generally, so we allocated exposure to Europe. An interesting point is emerging markets, which now on a full exposure basis are broadly equivalent in terms of our UK allocation. We are actively considering that area and determining whether actually to raise that exposure further.
How are you going to balance that with sort of business as usual for existing investors? Because of course they've been used to the trust being run in a certain way under Jeremy Teague, and indeed for longer than that, and a certain kind of dividend, a certain kind of performance. And now it sounds like you're changing the strategy quite a lot. Is this to facilitate business as usual, or will investors see a change?
Well, I think a key point is that the changes which are taking place and will take place are evolutionary in nature. The objective of the trust is long-term growth in capital and income, and that is what has been achieved through time. So the changes which have been made and will be made are entirely consistent with that. As far as the end investor is concerned and shareholder is concerned, there won't be any change in terms of that objective. Really, it reflects, again, where we see the opportunities going forward being much more overseas, and rather than constraining ourselves to the domestic market.
And where are the concerns then for you? Because you've mentioned where the opportunities are, that is taking a more global approach, but what are you concerned about as a fund manager?
Well, I think we have to recognise that the markets have moved a long way, and we moved from a point really of significant undervaluation in risk assets globally, that's equities and credit, and very depressed earnings levels and dividends levels 5 years ago, to a point now whereby that value gap is really gone, and markets now are trading at fair value at best, and in many instances probably slightly rich against fundamentals. Earnings have in some instances gone through previous peaks, but in other instances such as Europe actually they're some way below. So I think as always there are a number of concerns, one of which is just how far markets have run. I think a lot of that actually reflects a repricing of risk, but really for markets to make substantial progress from here we need to see fundamental improvement. There is a reason why policy has been so loose, and that is that the underlying economic environment is very tepid, and we need to be concerned about the very narrow path which we're treading today, essentially between the outlook for interest rates and the outlook for growth. Too much growth, and that may unsettle equity markets with interest rate rises, and too little, as we see concerns in Europe clearly today, that may lead to a deflationary outturn, which is similarly bad for equity markets. So there's lots of things to be worried about, but also lots of opportunities.
You've mentioned there predominantly equity markets, but you did say credit in that answer. Where are you positioned in terms of fixed income, and what's your opinion about it?
Well, we don't have direct credit exposure. We do borrow, however, so we do use bank facilities in order to finance investments. And my view on credit and on fixed income markets in general is that value is somewhat lacking there. And that's a good environment to borrow. But as I said earlier, the asset prices which we're actually paying on in terms of investment have moved a substantial way already. So we've actually been reducing gearing again from around 15% 18 months ago down to a level of 78% today. We look at currency in terms of borrowing from a multi-currency perspective. So again, there's lots of opportunities. We've borrowed in yen, which was a very good decision which was made given the depreciation of the currency. And that helps in terms of enhancing returns for investors, not just by levering up returns, but by using borrowing in a smart way and taking advantage of economic trends across different markets beyond the UK again.
Paul, thank you very much.
Thank you.
This is Emma Wall for Morningstar. Thank you for watching.